$97. That's where silver opened Monday morning. Electronic markets gapped limit up, every screen flashing green. And then, in less than 6 hours, $87, a $10 collapse. 10% intraday swing, the largest single-day volatility in silver since March 2020. And while everyone's trying to understand what just happened, I keep asking myself 3 questions. Why did the dollar strengthen during a geopolitical crisis when it should have weakened? Why is physical gold trading at $6,329 in Shanghai when Western markets show $5,400? And why is the gold-silver ratio spiking to 62-to-1, exactly when institutional forecasts are calling for $8,000 gold? My theory is this: we just witnessed the opening act of a market structure break, where Eastern physical demand and Western paper pricing decouple permanently. And the volatility isn't chaos. It's the symptom of 2 systems trying to price the same asset with completely different supply-demand fundamentals. Let me show you the pattern, because this has happened before in other commodities. And every time, the physical market eventually wins. I'm not a financial advisor. This isn't financial advice. This is real-time pattern analysis based on cross-market pricing data, currency correlation breakdowns, and historical precedent from physical paper divergences in other asset classes. And what I'm seeing suggests Monday's whipsaw wasn't irrational volatility. It was rational repricing of 2 different realities colliding. Let me give you the framework first, because extreme volatility events follow a specific pattern. 4 stages. Stage 1 is gap euphoria. Markets open with massive gap. Everyone who positioned over the weekend feels vindicated. Silver at $97, gold at $5,550. The gap holders are celebrating. Social media explodes with "I told you so" posts. This lasts 30 minutes to 2 hours. Stage 1 is emotional peak. Stage 2 is reality check. The gap was based on weekend news and Asian physical premiums. But once Western markets fully open, once liquidity increases, once algorithmic traders engage, price discovery actually begins. And sometimes, often actually, the initial gap was overdone. Profit-taking hits, leveraged longs get margin calls, stop losses trigger, and the gap starts filling. Silver falls from $97 to $93, then $90, then $87. This happens in hours, not days. Stage 2 is gap fill violence. Stage 3 is confusion and capitulation. Retail traders who bought the gap at $95 are now down 8% in one session. They panic sell. The people who were euphoric at stage 1 are capitulating at stage 3. Meanwhile, informed buyers who understand the pattern are accumulating at $87 to $90. Stage 3 is the emotional bottom and the strategic entry point. Stage 4 is stabilization and reassessment. Markets close Monday. Overnight, participants digest what happened. By Tuesday morning, the question becomes, was Monday's drop a healthy correction within an uptrend, or was the gap a false breakout? The answer depends on what happens next with geopolitical developments, dollar behavior, and physical market signals. Stage 4 is when the real direction gets established. We just completed stages 1 through 3 on Monday. We're entering stage 4 now. And understanding which scenario we're in determines whether $87 silver was the dip to buy or $97 was the top to fade. Now let me show you what happened mechanically. Silver gapped to $97 at electronic open Sunday evening. That gap was based on Asian physical premiums, weekend geopolitical stress, and safe haven psychology. But here's the critical variable nobody was watching: the US dollar index. Normally, during geopolitical crises, the dollar weakens as investors flee to alternatives. But Monday, the dollar strengthened. DXY rose approximately 0.8% to 1.2% depending on the session. Why does that matter? Because precious metals are dollar-denominated. When the dollar strengthens, it takes more metal to equal the same dollar value. So even if underlying demand for precious metals is strong, a rising dollar creates downward price pressure. Here's the mechanism. If you're a non-US investor holding euros or yen, and the dollar strengthens 1%, your purchasing power for dollar-denominated assets like gold and silver just decreased 1%. So you need the metal price to rise more than 1% just to break even in your local currency. That creates selling pressure or reduced buying interest. And reduced buying interest into a gap creates gap-fill dynamics. So Monday's move wasn't irrational. Silver gapped on geopolitical safe haven demand. Then the dollar strengthened, creating counterpressure. The two forces collided, and the result was a $10 intraday swing. Both moves were rational. The collision created the volatility. Now let me show you the divergence that's far more important than Monday's volatility. Physical gold in Shanghai closed Monday at approximately $6,329 per ounce, according to reports. Western spot gold closed around $5,400. That's a $929 premium. Let me repeat that. Physical gold in China is trading at 17% premium to Western paper prices. That's not a normal arbitrage spread. That's a structural divergence. And it's telling you something critical about global supply flows. Silver in Shanghai reportedly closed near $110 per ounce equivalent, while Western silver was at $87. That's a 26% premium. Even accounting for VAT, import duties, and local market structure, these premiums are extreme. They're signaling that physical metal is flowing east and not coming back. Here's the pattern. When physical markets in one region trade at sustained premiums to paper markets in another region, it means physical supply is constrained in the premium region. Chinese buyers are willing to pay $6,329 for gold that's worth $5,400 in New York because they can't source sufficient quantities at New York prices. That's not speculation. That's supply constraint revealing itself through price. And here's why this matters structurally. If Chinese demand continues at this pace, if premiums stay at 15% to 25%, metal flows from west to east. Refineries ship gold and silver to China because that's where the highest prices are. Western physical inventories drain. And eventually, Western paper markets lose credibility because there's not enough physical metal backing the paper contracts. That's the mechanism of a physical paper decoupling. And we're watching it happen in real time. Now let me show you historical precedent for east-west divergences. This isn't the first time. Example 1. Palladium, 2000-2001. Russian supply dominated the market. When Russia delayed shipments, physical palladium in Asia traded at massive premiums to Western futures. Eventually, Western futures had to catch up to physical reality. Price went from $400 to $1,100. The physical market won. Example 2. Rhodium, 2019-2021. Automotive demand surged. Physical rhodium in China traded at premiums to London fixing prices. Western paper tried to maintain lower prices, but eventually had to adjust to physical reality. Price went from $2,500 to $29,000. Again, physical won. The pattern. When physical markets in consuming regions, Asia, diverge from paper markets in financial centers, New York, London, the physical eventually pulls the paper higher. Not immediately, not smoothly, but eventually. Because you can't deliver paper. You can only deliver metal. And if metal is scarce in consuming regions, price must rise until supply meets demand or demand is rationed. Now let me address the dollar strength puzzle. Why did the dollar rise during a geopolitical crisis? Normally, crises weaken the dollar as investors flee to alternatives. But there are scenarios where the dollar strengthens. First, if the crisis is centered in regions that use dollar-denominated debt. Middle East entities with dollar debt need dollars to service that debt. They sell local assets, buy dollars, create dollar demand. Second, if the crisis creates dash for cash psychology, investors sell everything to raise liquidity, including gold and silver, and sit in cash temporarily. Third, if interest rate expectations shift. If the crisis makes rate cuts less likely because of inflation fears from oil spikes, higher expected real rates support the dollar. Monday likely saw a combination of all three. Oil spiked, creating inflation concerns. That made rate cuts less certain. Dollar debt servicing needs increased, and some leveraged positions forced cash raises. The result: dollar strength despite geopolitical chaos. And that dollar strength pressured dollar-denominated assets like precious metals. But here's the critical question: is that dollar strength sustainable? If oil stays elevated, if inflation pressures build, if central banks can't cut rates, the dollar might stay strong short term. But medium term, inflation erodes dollar purchasing power. And that's where precious metals benefit. So the Monday dollar spike might be a short-term headwind, but a medium-term setup for stronger precious metals moves once inflation data confirms the oil-driven price pressures. Now let me show you the $8,000 gold thesis. According to reports, major financial institutions, including some large banks, have issued forecasts calling for gold to reach $8,000 or higher in coming years. The core argument isn't geopolitical, it's portfolio allocation. Currently, institutional investors hold approximately 1 to 2% of portfolios in gold on average. If that allocation were to increase to 4 to 5%, which would still be below historical averages from prior decades, the capital flows into gold would be enormous. Here's the math. Global institutional assets under management exceed $100 trillion. If 1% is in gold, that's $1 trillion. If allocation increases to 4%, that's $4 trillion. The entire gold market cap is estimated around $13 to $15 trillion. An additional $3 trillion in institutional flows would require either massive price increases to accommodate the buying or physical supply that doesn't exist. Since you can't mine significantly more gold quickly, price becomes the adjustment mechanism, and the math suggests $8,000 or higher is plausible if the allocation shift occurs. What would drive that allocation shift? 3 catalysts. First, sustained inflation that makes bonds unattractive and equities volatile. Second, geopolitical instability that makes traditional safe havens like treasuries less appealing. Third, central bank precedent. If central banks continue buying gold at 1,000-ton annual rates, institutional investors might follow their lead. All 3 catalysts are active right now. Now let me address the silver supply deficit thesis. According to industry data, silver has been in structural deficit for multiple consecutive years. That means consumption exceeds production plus recycling. The deficit in 2024 was approximately 150 million ounces. 2025 estimates suggest 120 to 140 million ounces. Where does that deficit come from? Above-ground stockpiles. Inventories are being drawn down to meet demand. And here's the additional factor: military applications. Modern weapon systems use silver for conductivity, radar, electronics. If military production increases due to geopolitical tensions, that's incremental demand on top of already stressed supply. Some weapon systems reportedly use 5 to 15 ounces of silver per unit. If production scales up significantly, that could add millions of ounces of annual demand. Not enough to drive the market alone, but enough to tighten an already tight supply picture. The supply deficit doesn't create immediate price spikes. It creates structural pressure that builds over time. Think of it like water slowly draining from a bathtub. At first you don't notice, but eventually the water level drops enough that it becomes obvious. Silver inventories are in that slow drain phase, and Monday's volatility might be early signs of that drain becoming visible to more market participants. Now let me show you the gold-silver ratio strategy. The ratio Monday spiked to approximately 62 to 1, according to market data. That means 62 ounces of silver equal 1 ounce of gold. Historically, the ratio averages around 60 to 1 over long periods, but it swings widely. It's been as low as 40 to 1 and as high as 120 to 1 in recent decades. Currently at 62 to 1, we're slightly above the long-term average, but not extreme. Here's the strategic framework. When the ratio is above 60 to 1, some investors view silver as relatively cheap to gold. When it's below 50 to 1, gold is relatively cheap to silver. The idea is to swap between the metals based on the ratio, accumulating more ounces over time. For example, if you hold gold and the ratio hits 70 to 1, you swap gold for silver. If the ratio then falls to 45 to 1, you swap silver back to gold. You've increased your total ounces without adding capital. But here's the challenge. Ratio timing is difficult because the ratio can stay extreme for years. It can go from 60 to 1 to 80 to 1 before reverting. So using the ratio as a timing tool requires patience and conviction that mean reversion will eventually occur. For those with that patience, Monday's spike to 62 to 1 with silver at $87 might be viewed as a relative value opportunity. Now let me address the COVID comparison. In March 2020, silver crashed from $18 to $12 in weeks. Then it rallied to $29 by August. That's 141% in 5 months. The comparison being made is, if silver crashed Monday from $97 to $87, could it rally similarly over coming months? The pattern would be geopolitical shock, initial spike, violent correction, then sustained rally as fundamentals reassert. The logic: Monday's drop shook out weak hands. Those who bought the gap at $95 panic sold at $88. Now those sellers are gone. The float is cleaner. And if geopolitical stress persists, if physical demand from China continues, if dollar strength fades, silver could rally from $87 to $110, $120, or higher over weeks to months. Is that guaranteed? No. But the pattern has precedent. Violent corrections often create strong bounces in trending markets. The question is whether we're in a trending market or a failed breakout, and we won't know until we see price behavior over next several sessions. Here's the risk management framework for navigating this volatility. First, understand your time frame. If you're a long-term holder based on structural thesis, currency debasement, supply deficits, geopolitical instability, Monday's $10 swing is noise. Ignore it. If you're a trader trying to catch short-term moves, Monday taught you that gaps can reverse violently. Respect that. Second, position sizing. If Monday's volatility created emotional distress, your position is too large. The correct position size is the one that lets you hold through 10% intraday swings without panic. If you can't do that, reduce size. Third, use dollar correlation. When dollar strengthens, expect precious metals pressure regardless of geopolitical news. When dollar weakens, expect precious metals strength. Monitoring DXY gives you early warning of pressure or support. Fourth, watch physical premiums. If Shanghai premiums stay at 15% to 25%, the divergence is real and structural. If premiums normalize to 2% to 5%, the divergence was temporary. Sustained high premiums predict eventual Western price adjustment upward. Fifth, monitor oil. If oil stays above $100, Inflation fears support precious metals medium term, despite short-term dollar strength. If oil falls below $90, the geopolitical premium fades and precious metals could correct further. Now let me show you the opportunity framework. If you believe the long-term thesis, east-west divergence, supply deficits, $8,000 gold forecasts, Monday's correction created entry points. Silver at $87 versus $97. Gold at $5,350 versus $5,550. Those are 8% to 10% better entry prices than Sunday evening. For long-term accumulators, that's attractive. But if you think Monday's gap was the top and we're heading lower, then $87 silver could become $80 silver, and $5,350 gold could become $5,100 gold. In that case, waiting for further downside makes sense. The disciplined approach. Scale in. Don't try to catch the exact bottom. If you want to add exposure, buy a portion at $87 silver. If it drops to $82, buy more. If it rallies to $95, you got part of your position at good prices. By scaling, you remove the pressure to be perfect. Here's what I'm watching to determine if Monday was a dip or a top. First, Tuesday through Friday price action. Does silver hold above $85? That suggests Monday was the low. Does it break below $85? That suggests more downside coming. Second, Shanghai premiums. Do they stay elevated or normalize? Third, dollar behavior. Does DXY strength persist or fade? Fourth, geopolitical developments. Do tensions escalate or de-escalate? Fifth, physical demand reports. Are dealers seeing increased buying after the drop or decreased interest? These signals over the next week will clarify whether we're in a corrective dip within an uptrend or a failed breakout heading to lower levels. Now let me address the Fear and Greed Index reference. Some sentiment indicators showed fear zone Monday, despite the geopolitical crisis. Normally, fear drives precious metals higher as safe haven demand increases. But if fear is present and metals aren't rallying, it suggests either A, the fear is misplaced or overblown. B, other factors like dollar strength are overriding the fear premium. Or C, the fear hasn't translated to capital flows yet, but might with lag. My interpretation: the fear is real, the geopolitical stress is real, but the dollar strength and profit-taking dynamics created counter-pressure that dominated Monday's session. That doesn't mean the fear premium is gone, it means it's delayed. If dollar strength fades and geopolitical stress persists, the fear premium could reassert itself in coming days. Here's the structural view. Regardless of Monday's volatility, the underlying drivers remain intact. Shanghai trading at $6,329 gold versus $5,400 in New York. That's real. Silver supply deficits for multiple years. That's real. Institutional forecasts for $8,000 gold based on allocation shifts. That's plausible. Dollar strength on Monday. That's temporary unless inflation is somehow contained despite oil spikes, which seems unlikely. So the long-term thesis is intact. Monday was short-term volatility within a larger structural pattern. The challenge is holding conviction through the volatility. Most investors can't. They buy the gap at $95, panic sell at $88, and miss the rally to $110 that might come in weeks. That's why discipline matters more than conviction. The pattern is clear. East-west divergence is structural. Physical premiums in Shanghai aren't noise. They're signals of metal flowing toward regions with strongest demand. Western paper markets will eventually adjust to physical reality. Not smoothly, not immediately, but eventually. Because you can't deliver paper, only metal. So here's the question. Are you going to let Monday's $10 swing shake you out of a structural position? Or are you going to recognize that volatility is the price of being early to structural shifts? Because if the east-west divergence plays out, if Shanghai premiums stay elevated, if Chinese demand continues draining Western supply, the people holding physical metal at $87 will look back and realize Monday's panic created the best entry point of 2026. The choice is yours, but understand what you're choosing between: short-term comfort from avoiding volatility, or long-term positioning for a structural market break that's already showing up in cross-market pricing data. If you want to follow these divergence signals in real time, subscribe, because Shanghai premiums, dollar correlations, and physical demand flows are updating daily, and understanding which signals matter, which are noise, and how to position accordingly, that's the edge. The people who see structural breaks early don't wait for confirmation. They position during confusion. And Monday was maximum confusion, which means it might have been maximum opportunity.